Markets exploded higher at the open this morning, gapping up nearly 2.5%, but couldn't hold those early gains. The S&P 500 ended the day up just 1.6, while the Nasdaq closed 2.5% higher after a strong tech-led surge faded into the close. What's behind the rally? Cooler political rhetoric from President Trump, renewed confidence in the Fed that maybe Powell won't be fired before the end of his tenure. And then sharp moves higher in the Mag 7 names like Tesla, NVDA, and Amazon. Meanwhile, the VIX dropped today, signaling easing fear, but is that a green light for risk on or a short-term trap? The VIX is right at an inflection point. We'll talk about where it's at and what we need to see tomorrow and Friday to kind of dictate what kind of outlook we have going forward. Tonight's market outlook, I'll break down the gap and fade setup, some key technical levels to watch as always, and what today's action means for the broader trend, this correction that we've been in. Are we done with it or not? I'll also review the trade idea that I placed earlier today in the Market Outlook Live, walk you through the logic behind the setup. So let's go ahead and get started. Today is Wednesday, April 23rd, 2025. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching here on our blog, sign up for a daily Market Outlook email over here on the right. This is our Market Outlook Live. If you click on this, it takes you to where we take a look at all the old Market Outlook trades to see whether we should stay in them or not or get out of them. We also put on today's trade already before our market closed. Come down to the bottom, click this heart. It opens up a new tab where you can like today's Market Outlook tweet. Click this thumbs up. Also takes you to a new tab where you can like today's Market Outlook Facebook posts. Again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator. As you can see, we did rally today. We gapped up. We did not build on that gap very much, though. As you see, the SPY looks a little different than SPX does. We went up a little bit there, up to that 30-day moving average, and then pulled back. So as a result, the near-term line rallied into bullish territory, crossing above the 60th percentile, but it didn't. This is day 2 of being out of bearish territory, and we're not above the 80th percentile. And your momentum line actually declined. Now, again, that does not guarantee that it won't get into the upper reversal zone, which is where we want it to get to. But it makes it less likely, again, kind of similar to this, just to a larger degree, it makes it less likely that it will get now into the upper reversal zone. So not necessarily the thing that we wanted to see. The nice thing is the intermediate line smack dab in neutral territory. So at least it's not bearish. It's moving sideways. It's in neutral territory. It's above market sentiment. So, you know, we're above the 2.5% mark, the minus 2.5% mark, relative to the 30-day moving average. So there's a lot of positive things here. There's just not enough to say the trend has changed, right? We really need to see us move above 2 Wednesdays ago, 2 weeks ago, the high of 2 weeks ago there on the 9th, where we rallied at 9.5% on the S&P. Well, we still haven't gotten above that high and gotten into this gap, as you'll see here later. The gap from at the open on April the 3rd, that's a really, really important gap. We get into that gap, things change. But holding that gap as resistance, as we did last week already once, and now we're doing it so far this week, we'll see if that ends up producing another bearish near-term peak here. We are a little bit closer to the moving average this week than last week because the moving average has been falling. We do have light green shading. We still have that red line there. Take a look at the NASDAQ 100. Of course, it looks very similar. And still below its moving average. Looking at the Dow Jones Industrial Average, you can see again it was up 1%, but down way off of its highs of the day, and filling in almost all of the gap. You see diamonds, you see a little different story there, filling in a lot of the gap that we had, and still more to fill in. And then finally, let's take a look at the Russell 2000. Same idea, right? Light green shading. The intermediate line's rising. Even if it's sideways in all the other indicators, it's still, at least it's rising. We have the light green shading. Here we also have the light green shading and the intermediate line's rising. It's still in bearish territory. Remember, the Russell 2000 actually did have a pretty strong bullish momentum peak yesterday, getting up above the 90th percentile. So, today getting the near-term line above the 80th percentile slightly. Again, if we can break through that moving average, then we can get a good intermediate run started here. But if we don't, if we get kind of a bear tag type pattern and bounce back down, then that's obviously means that we're that we're not going to. That near-term line fails again. So it's really important here in the next couple of days that near-term line get above 80, right, and really produce a strong bullish peak that it was not able to produce the last couple of peaks. It did over here on this one, this near-term rally. We did get above the 90 a couple of times before falling back. But at that point, we did have the inklings of a intermediate rally, right? It's a little bit more steady than the one that we've been getting here. The one that we've been getting has been strongly up and then down and then up again and then down and then now it's up. And we kind of have to break out of this up and down cycle, and it really depends upon that. I think resistance will hold. I expect resistance to hold until it doesn't. So I expect this resistance to hold until we get some kind of headline that produces enough bullish energy and sentiment to push us through. And then once that happens, then I think we have our escape velocity at that point. Until then, barring that, then you expect the technical resistance to hold and we'll make a move lower again, back down to the downside. If you look at the weekly chart, again, a transition candle. It's 2 weeks in a row of transition candles. So again, this would be a bullish transition candle if it were an actual bullish candle. And it's somewhat bullish. It's not bearish. It's still a little bit of a doji type pattern, but still not the kind of pattern we like to see, which either suggests another transition candle next week or a continuation pattern, right? That's usually what happens instead of a reversal. You can see next week's candle, as of now, we got 2 more days left, but next week's candle will open up, Hakinyashi candle will open up at 53.20, the midpoint of this week's body. That's where the open will be. Right now we're trading at 53.75. So again, we're not necessarily strongly bullish here, at least strongly bullish enough to make these transitions a reversal, right? A reversal candle up to the upside. If I take a look at the 3 green arrow chart, you can see again we have the green arrows. We have 2 on the MACD and stochastics on all these indicators, including the Russell 2000, and today getting on the diamond. We just don't have that 3rd red arrow yet, which gets us above that moving average. So we can tomorrow, and if we do, it'll be because we are getting above that Wednesday, that high point from April the 9th from 2 weeks ago, and getting in to that April the 3rd gap there. And you can see that a little bit clearer here. You can kind of see that would get us up above the 30-day. It would still keep us below the point of control, still keep us below the 50 and 200-day moving averages. But the MACD is positive. This is the first time since April the 9th that we've closed above the 17-day moving average. So that's a positive sign. We just haven't quite, we've done it before. We did it on April the 9th. We did it over here in the end of March, and we failed, right? So we know there's a pattern there that we need to avoid for us to be bullish here going forward. Looking at the DMI, you can see the negative indicator is still above 25, but the positive indicator is above 20. So again, we haven't had that for a while since that late March peak, that post-expiration peak here. So again, we have an opportunity to kind of break this trend and get going to the other side. Otherwise, again, as we've seen before, and as I told you before, when these lines get, when they bid strongly above 25 or below 20 and they get to those levels, they can act as a resistance before, we finally break, they cross over and we break through to the other side. So, that's kind of what we're seeing there. Looking at the RSI and the CCI, they're still at, very, very poor levels. I mean, we're still below in the lower half of the chart on the RSI. We're still not, we're above 0 on the CCI, but we're not above 150. So, we're not getting strong bullish breakout signals here. Looking at the Ichimoku cloud, we are still even though we're above the blue line, so we're above the midpoint of the 26-day range, we still have a very mature bearish trend. Usually when you get above this blue line, that's a good sign that the trend has ended and both these lines hit zero. But that's not the case, and the rate of change is still clearly negative, and we're still clearly below the Ichimoku cloud. If I take a look at the Bollinger Bands and the Keltner channels, we are at the midpoint again. So it's not like we haven't been here before. We're at the value area too, the bottom of the value area, which also acts as a resistance. You can see the momentum is negative. It's waning, but it's negative, and the bands themselves are moving inside to being inside the Keltner channels. So that will actually limit the downside. Remember, we talked about when there's a pretty decent gap between the two, there's a good chance we can trade inside that gap, which means a pretty good down day. And we were there at expiration, close, but fortunately we didn't follow through on that. If you look at the intraday range, you can see again that we got up to last week's high point, the week before, same high point from the week before, and you can see the gaps are like right in this area. So we can get up there, we can get into the upper, like you can see here on this chart. We're not quite above the 60th percentile yet on the stochastic. So breaking through there will get us into bullish territory, and we really prefer to be up here. So until then, this area can act as a peak. When you're bearish, the 60 level can act as a peak for this line, and giving us a harder time to get through. So it's really, really important that we break through there to the upside. The volume, if you take a look at the volume and the trading range, very minimal trading range today. Again, of course, you still have the gap. But that's not really what you want to see as having most of our gains. In fact, when you look at it this way, we had a really large gain today. I tweeted out about that earlier this morning. 2.5%, the second biggest opening gap of the year, the biggest one occurring, there's right before that April 9th move. It was on April the 8th. We gapped up 3.5% almost to the upside. And remember, the April we finished down that day 1.5%, and then the next day on April the 9th we gapped down to open before rising 9.5% or 10.5% on SPY throughout the course of that day. So strong move, but again, just like we saw there, getting a large gap, getting a 2.5% move on very, very low volume, very illiquid market. Unless we build on that when the volume kicks in, then a lot of times we start to fill it in. And, filling in a big 2.5% gap is not what we want to see. If you take a look at the money flow, again, you can see we're right here. We're right at the same level as April the 3rd, pretty close to April the 3rd. If you look at where the money flow was in April 3rd, it's about right there. So if you follow my cursor over to the right, even though the price is at the same level on a closing basis than where we were on April the 3rd, the money flow is not anywhere near catching up to what the price is doing. And you can see the oscillator still down in bearish territory. So the volume's really not kicking in for what we want to see. As you'll see, breadth here too, on some levels, is not really kicking in either. If I take a look at the VIX, right? The VIX, which didn't go up very much when the market was down yesterday. Well, it came down and finished below 30, still above 100% relative to the VIX 3M, but the VVIX dropping below 110 is a very, very good sign. Again, it needs to get below 100 so we can get out of this. We need to get below 100% here so we can get out of this, and we can see the VIX on its own compared to itself is still above its moving averages, in this case the 30 days. So we're not out of this yet, but you can see we're in the right direction. We're moving in the right direction on all those indicators, and if we get one more breakdown on the VIX, whether it's relative to these averages or relative to the VIX 3M or the VVIX of the VIX, if we can get one more big drop, then we can feel pretty confident about the breakout move taking place. Again, up to a new intermediate high point. Now, whether that's a new higher high compared to the last peak we were coming down from remains to be seen. But at least, the correction low will be done, and we'll be in the midst of that fourth stage of the correction bounce and watching for a possible failure or not. All right, now let's talk about what's driving this price action today. Let's take a look at the asset class comparison chart and take a look at how the major assets, you can see the big drop that we've had in gold the last couple of days. Let's just look at today first. And you can see, look at that drop, 2.38% today, almost 2.5 commodities down. The S&P and the Qs and the U.S. stocks just in general up higher. The bonds, so bond yields were lower today, and the dollar jumped up. So all these moves that we've had here lately during a lot of this decline, if I were to take a look at, let's see here, see exactly when this decline, this current leg started was back here on March 26th. So if I were to look at March 26th here, you can see March 26th right there. Let's go to like a 15-minute chart. You can see at one point in time, gold was up quite a bit. The dollar was down quite a bit. Bonds were down quite a bit. And so, of course, and commodities were actually down quite a bit too, and they stayed down. Everything else reversed, right? U.S. equities were on top. Gold's on bottom by quite a ways. The dollar rallied today, as you saw, and bonds fell. So everything reversed course, and that's pretty much why we had the day that we had today. You can see the dollar index jumping up towards its 8-day moving average. The MACD is still above its moving average. Stochastic's getting above 20. Again, not changing the trend, but still relatively bullish. When you look at bonds, you can see they gapped up huge today and fell down and filled in most of its gap. In fact, if you look at its daily move here, daily percent price moves, you can see that we were up. I mean, this is the biggest gap we had all year, and we only finished up less than 1% after gapping up almost 3%. So big fill there from long-term bonds. If you take a look at TNX, the 10-year yield, you can see it gapped down and opened up today at a 4.3% and finished today back up to 4.4%. In fact, we were only down 2 basis points. We closed yesterday at 4.389. We closed today at 4.387. In fact, not even 2 basis points, 2/10 of a basis point. So we didn't even fall a basis point today after gapping down quite a bit to the downside. So that's a big move throughout the day on yields after starting the day lower. Again, all of this is coming from the idea that Trump's not going to fire Powell. Now, he did come out after the market closed and kind of walk some of that stuff back. But there was some chatter from Besson about the China tariffs. They might roll back from such high levels. Like I said, Powell's not going to get fired. So a lot of that got walked back in the morning. But then by the afternoon, some of that got walked back. So it's clear that the market is just hanging on headlines right now as we are going through a major portion of the earnings season, right? And you see big names. I mentioned Tesla earlier. You can see Tesla was up over 5% after its earnings announcement, but you can see it wasn't necessarily trend changing. We'll talk about this more here in just a minute. We also talked about Amazon earlier today at 4%. Again, pretty good jump, but right at resistance, right to the point of control, right to the moving average there. And then finally, I also mentioned NVDA. And you can see NVIDIA jumped up today too, up almost 4%. But again, it doesn't look like. In fact, if you look at the Mag 7 grid here, and you look at Apple and Microsoft and NVIDIA and Amazon and Google and Meta, light green shading in a red line, but it doesn't the only one that's really broken through is Netflix. Netflix is up to its 3-month high point here. Everything else is still pretty negative. IBM. So this is sorted by their weightings in the S&P 500. So some of those old stocks that were here have moved out in the bottom 3, and these have moved up. All your Mag 7 names are still obviously in here, and Netflix, and Broadcom have kind of been added at various point in times to either FANG or a Mag 8. So they're still there too. So those are your top 9 stocks, and then these 3 have been kind of rotating through between Qualcomm and AMD, and now Salesforce and Cisco, and IBM is bullish, but everything else is kind of bullish, but not trend changing bullish. I had a tweet here that said that the Mag 7's over with; it's not coming back. If you look at the weekly charts, these are 3-year weekly charts for all the Mag 7 names. yes, we are in correction mode. We're breaking the 50-week moving averages on pretty much all of these. The only one that we haven't really is IBM. But everything else, we're kind of sitting, and Broadcom for that matter, Meta to a smaller degree. But they're all either breaking the 50 and moving towards the 200 or sitting on the 200, all of them. You can see Netflix is the best one out of all this bunch because it hasn't even broken the 8-week moving average. It's been pretty bullish here, like I said, up to its 3-month highs, and I mean those are the 3-year highs for Netflix. But if you notice, 3 years ago they were all on their 200-week moving average as well. Back at the beginning of these charts, either on it or below it, right? Some of these were pretty far below it, but they were all, and this Netflix is way below it, and they've all rallied, right? So that Max 7's not over with. Just because they're in correction doesn't mean that they're done, right? If the market bounces off this correction low point to new highs, I don't expect that it will, but if it does, because we have to, the odds are that it will. And so if it does, it will be these stocks that lead the way higher because, if you look at the sector weightings here for the S&P 500, here, let's go here. If you look at the sector weightings, in fact, if you just look at the top, 9 companies, so 1, 2, 3, 4, 5, 6, 7, 8, 9 companies, which are the MAG 8 plus, Netflix. Actually, it's not even Netflix here. It's Broadcom and Tesla. So let's see here. Is that 9? Yeah, 9 companies. 1, 2, 3. Oh, Berkshire. 4, 5, 6, 7. So Berkshire has actually made its way up here. But if you were to look at, well, here, let's just do it this way. Sector S&P 500 sector weightings. Sector weights. We'll go to the SPY. It's still, 31% technology, 10%, so we're looking at 41.3%. This would be 19.6, so about 20% here. So you're still, about 50% of the market is still in those 3 names: technology, consumer discretionary, communication services. 50% of the market still in those 3 names. If you look at, again, the sector weightings here, let's go to the NASDAQ 100. And you look at again, 1, 2, 3, 4, 5, 6, 7. Alphabet would be 8, and then 9. So looking at the top 10 companies and Costco on top of that. So the top 10 companies here, you're looking at a 48% of the NASDAQ 100 is in those MAG 7 plus names. So, again, if the market's going to rally off of these correction lows and bounce up to new highs, it will be led by those numbers. But at least at the beginning, if you look at how the sector rotation moves here today, and we'll look at the last 2 days of this bounce that we've had. But just looking at today here, you can see, your big winners are who you'd expect to be. In fact, if you look at the last 2 days, combined, at one point in time this morning, they were up 7% in 2 days before we started to come back down and fill in. But they're still outperforming communication services, matching. So when the market's going to rally, it's going to rally off of those lows, right? If you go back to April the 10th, when we had that big bounce on April the 9th, and then we pulled back on the 10th, and then that kind of set the low point for this Zweig breadth thrust that a lot of people have been talking about. Well, if you look at that, from that low point going forward, they're not leading. So we've had this Zweig breadth thrust. Let me show you what I'm talking about there. So what that is, and a lot of people have been tweeting about it, is when you have a big strong move in breadth, right? So it's the number of advancers on a ratio to total issues. So the percent advancers essentially, which has been really high over the last little bit. Here, let's zoom in on the last 3 months so we can see it. Oops, 3 months and 0 years. Let's try that again. So you can see, we've had since April the 10th, when we finished below, when we were at 10% of new high of advancers, 10% of total issues were advancers. From that day going forward, we hit 70%, then we hit 78.5%. I'm looking at the number in the box here next to the C. We dropped down to 36%, then we had another 74%, a down period there on 14, and then we had a 90%, and then we were at 90 again today before the pullback. To the point where, so this is what the breadth thrust is. When you're, the last day that you're below 40% on the 10-day exponential moving average, which you can see here, if you follow look at my cursors, right around 38% there. So the last day that you're below 40%, you have 10 days to get this average above 61.5%. So today we were close when we were at the highs, when we were at 90% here, advancers, we were close. The pullback obviously affected that, and then now the average only at 57. We have 2 more days, so we've had 8 days so far since April the 10th. We only have 2 more days to get to the 61.5%. The last time we had a breadth thrust was back in 2023. It was October of 2023. October 2020. We bottomed out on the 27th. So starting, it was just a few days, going to November, November the 3rd. So it was a week, right? We had a week's worth, 5 trading sessions there of a breadth thrust. And you can see during that period of time, XLK, XLY, and XLC led the markets higher. And you also had real estate, which kind of matches that sometimes, and financials. But those 3 all outperformed the markets. I mean, that was a strong breadth move to the upside. We had a breadth thrust. But as you just saw, those are not the sectors leading the way higher from April the 10th, right? When you look at it again here, you know, we're being led higher by, in fact, those are the 3 sectors actually lagging. It would be on the 11th starting forward. Those sectors are lagging the rest of the market. So the first day, the bottom was the 10th, so this is the first up day was on the 11th. And we've had some ups and downs, but real estate, energy, materials, utilities, staples, those are all the sectors outperforming. That is not a broad swath. I mean, it's been great for breadth, and that's why we're getting kind of this breadth thrust. But usually when everything's going up, but these 3 are leading, that's the kind of breadth thrust we really want to see. And then as I showed you before, not only are we not really getting a strong move, you can see if I look at the McClellan oscillators today, you know, we were at one point in time at the highs of the day today, we were above 75. That's why I tweeted out about, that's why I drew that line there. We finished only at 60. So back here, again, was the last time we had our breadth thrust. All right, it was right. The Zweig breadth thrust was right here. We bottomed out on the 27th, below 40%. And on November the 3rd, we got above the 61.5% mark. On November the 3rd, the breadth here, the McClellan oscillator jumped up to big time levels. You know, we're only at 60 right now. When you look at the moving averages here, again, we're still below the 30-day moving average. But if you go back and look at what happened back on November, October to November during the last Zweig breadth thrust, by the time we got to November the 3rd, we went from being below all the averages to above all of them and above the 50-day. And we really turned, we never did get below the 50-day, and we turned it around, we took off to the upside. That's the kind of move we need to see, and we're not seeing that, right? We're still below averages. Now, if we get this thrust in the next couple of days, it probably does mean that we have broken through these highs, and now we're moving to the upside. But again, we have the point of control here. If you look at what it looked like back on that November the 3rd, so we'll go November the 3rd of 2023, and then we'll go a year before that, November the 3rd of 2022. So a 1-year chart here. We were above the moving averages. We are above the point of control. We were above the value area. So, you know, we had a breadth thrust and we were able to really take off. Here, we're getting close to a breadth thrust, but we're below all those lines. Even if we break into this gap and we actually get there on that on this line, and we actually get to the 61.5%, then we're going to still most likely be below the point of control and below the 50 and 200-day moving averages. So when you look at, you know, the fact that the money flow is not there, that the sector rotation is not driving it, then there's a lot of fuss being made about this thrust that we are now kind of, we've hit the low point, we're taking off. I don't think that's the case. I think we are still forming this low point. Now the low point's formed. We're not going to go very much lower than this at the worst case scenario. At the best case scenario, again, we kind of stay up in this area, but I think we're still retesting this low point. I don't think we're set yet to break up to a new to our new intermediate run. I don't think we're ready to start a new bullish intermediate run just yet before we get a new leg, a retest to the downside. So a lot of false signals associated with that SPY breadth thrust, not the type of breadth thrust we really want to see. And that brings us to our trade idea of the day, and it's on Tesla. Tesla just had its earnings announcement, and you can see the market really didn't move on us. So this would have been a really great trade to make, kind of sell the strangle on this, because it just didn't move outside of the range very much at all. I mean, it was up 5%, but you know, it was below average on the range. So 5% move is actually a below average move for Tesla right now. Lots of bear tags recently, but we're not really bouncing up, breaking up, and building on them, nor are we bouncing back down either. We're just kind of stuck in this sideways action. We got a yellow line. The near-term line's looking bullish, but not not as strong bullish as we would like to see. As you can see, at least it's not bearish though. If you look at the weekly chart, again, lots of transition candles here, week after week after week, so no reversal yet. Most likely will lead to a continuation, but as of right now, it's pretty neutral. Looking at the 3 green arrow chart, we obviously are above the moving average. The stochastics is turned green. The MACD is slightly, ever so slightly green there. So technically we have 3 green arrows, but that's about as weak of a 3 green arrow signal as you could possibly have. Barely above the moving average, barely above the MACD histogram, or barely above the MACD, barely above its average. Stochastics barely turning up and still below its average and still in bearish territory. So very, very weak 3 green arrow signal there. But again, at least it's a 3 green arrow signal. It's not a bearish signal. If I take a look at the DMI, eventually, if it will work here, there we go. If we take a look at the DMI, both the positive and negative lines are between 20 and 25, so basically signaling no trend right now. If I look at the RSI and the CCI, they're both in between. They're in their neutral territories, right around the chart midpoint, so no trend there. The Ichimoku cloud and trend strength indicators are also signaling no trend right now, and we're below. We're below the cloud, but we're above the blue line. We have a positive rate of change. And then finally, if you look at the Bollinger Bands and the Keltner channels here, you can see we're right at the point of control, and the bands are inside the Keltner channels, and the momentum was kind of bearish, but it's already starting to wane a little bit, and so this is a very good setup for, especially considering we're through earnings, for an iron condor trade. So what I decided to do was to sell the 20 deltas. So we sold, there's actually a 20 delta when we were looking at it, sold the 217.5, bought 1 strike away, came over here, sell the 20 delta, buy 1 strike away. So let's see here, let's set that up so you can see what it looks like on the Analyze tab. And we'll sell this. Didn't go through in the before the market closed, so we'll put it through for tomorrow morning. But if you analyze that and you put those break evens on the chart, that's where these lines are. So you can see the entire 4-week range is inside the break evens, and so is the entire Bollinger bandwidth. Oh, sorry, wrong chart. Let's try that again. So is the entire Bollinger bandwidth, right? When you look at it, it's also entirely inside the break evens, with the point of control smack dab in the middle of those break evens, and the bandwidth is starting to decline, or has been declining, and it's starting to decline again. So a good setup for an iron condor spread. We position size fully, right? So we can take, because we don't have to worry about the earnings announcement, so do the full $1,000 risk and getting a pretty decent reward for that risk. And knowing that if it does break out of this range, then that means we're trending. One way or the other, we'll be trending to the downside or trending to the upside, and we'll obviously look at a new trade on this. But in the meantime, while we have had a significant trending move, it looks like we're kind of slowing down and kind of basing, at least going neutral here for an expiration cycle or two on Tesla. Now that, again, that we're through the earnings cycle. All All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all tomorrow.